Hi, this is Stephen here from Share Navigator with your option and future trade update alert on November the 7th. So we're going to look today at four different potential trades. One's on the S&P 500, one's on crude oil, one's on TLT, which is an ETF that tracks 20-year plus treasuries. And we're also going to look at potentially a long call in Meta. So let's get cracking. So yesterday we had a bit of a jump in the VIX. It jumped up to 20. SPY sold off 1%. And futures today are showing pretty neutral at the moment. So yesterday we put in an order, which we didn't get filled on, to sell the $620 put option into December. We put in a limit order for 5. I think it got up as high as 450. So today we might look at putting on another trade there. Just to show you, first of all, before we go on, the NVIDIA long put that we did as part of our long put course, you can see it's up there $360. So that's benefiting from the current market sell-off. But anyway, let's look at SPY. We're going to look at the options going into December. And again, this is a high probability trade. So I would like to, anything below 640 for me is good on this trade in terms of picking a strike price. And again, just as a reminder, in terms of picking your strike price, you want to pick strikes with a delta below minus zero point 0.2 if possible. So we'd be kind of moving down towards the 635 strike. And you can see the last price yesterday was nearly $600 a contract on that. The 630s offered 526, and we were looking at the 620s. Now, they've ended up closing down at a 4, I think it was. So you can see here, our probability of profit in this trade will be 94%. The reason I prefer the 620s, if possible, it just gets me closer to the break even, which is near that 200-day moving average on the SPY. So if we get any type of a sell-off today again, that trade will be going on. A limit price at the 620 for 5. And if I don't feel that's going to get filled, I might up the ante to the 630. So I'd be looking at strikes anywhere between 620 and 630 on this today. I would like to get a trade on, start generating some income from that with a 80 to 90% chance of being profitable. So I will let you know if we go ahead and place that particular trade. The other one I'm looking at the moment is crude oil, and we were absolutely right to wait and not put our trades on recently. So again, just bringing you back to the chart here, you can see crude oil. I was concerned about these lower lows, and yesterday we created another low. Now today there's a bit of a bounce in it, all right, but it got below $59 a barrel. So I'm waiting on crude oil maybe to get to around 58 if possible, and then I'm looking at selling put options on the January futures contract and trying to get strikes of below 53, 52. And the reason I'm just being a little bit more conservative there, you have to factor in that, let's say, and it's unlikely at this moment in time, there's some sort of a news of a ceasefire between Russia and the Ukraine. You're going to see oil prices probably drop in anticipation of Russian oil coming back on the market. So you've always got to have that in the back of your mind when you're trading crude oil. So that's why I want to wait to see, can we, get our break even closer to that $50 mark. And then on the other side of the fundamentals, it's in nobody's interest to have oil below $60 a barrel. Very few companies make money at that level. Really, $75 a barrel is that mark. So you would imagine that supply will come out of the equation at some point in time, as it's no longer in the driller's interest to keep drilling. So you would imagine that will play out over a period of time, but there is that overhead risk of Russian oil potentially coming on the market. Again, it doesn't look like, unfortunately, anytime soon that's going to happen, but it's something you need to be aware of. The other one is TLT. So that's the ETF that tracks the treasury yields on 20-year US treasuries or higher. And the way to look at this goes up when interest rates go down, and vice versa. It goes down when interest rates go up. So if you think, for example, that in the US interest rates are not going to go up, selling put options on this is not a bad idea now. And now after yesterday's rally, I'd say no. But if we start getting premium, we're going to go into the options now in a second on this, getting a break-even price of in and around 86, I will be happy. So we'll be selling the $87 put option on this. So again, if we go into the December, expiry for TLT. We're going to look the option chain. We go to December the 19th expiry. You can see the $87 put. It's only offering $51 a contract at the moment. Now, if that got closer to $80 a contract, I'd be inclined to place that trade. And just back to the chart. So we're, again, in terms of, probability of profit on this trade, the 87 strike we're looking at an 83% probability of profit. And look at TLT. It doesn't move very much, guys. It's operated in the last number of months between $85 and $92. So it's a fairly tight, narrow range that this operates in. So if you think about it, if we're getting our break even in this trade close to 86, we're pretty much near the low. It's not to say it won't go back down there again, but interest rates would have to rise in order for it to go down there. And I don't think interest rates are going to rise anytime soon. Plus, if you do get a sign on this, you get paid a dividend every single month that amounts to just under 4% per annum. So I can think of a lot worse things to be doing than this particular trade, and generating 1% on something that's pretty stable with an 80% chance of getting it. I really like that. So if that premium there on the 87 strike gets closer to 70, 80 cents, I will be placing that trade, and I'll let you know about that. And then finally, I just want to talk about Meta. So Meta has been crushed since earnings. So you can see it's dropped down to yesterday. It went down to 618. As I said, once it gets into the low 600s, I'd be interested in buying. So I would be interested in buying this stock for the long term. And the reason Meta, by the way, is getting crushed is because of what they said in their earnings about the amount of money they're spending on AI. And this happened Meta before when they were talking about the metaverse. The stock got pummeled because they felt Zuckerberg had lost control. So if you look at this period of time, it went like from $400 to $100. It got absolutely annihilated because the market didn't like the fact that they were spending so much money on the metaverse with no idea of how they were going to monetize it. And something similar is happening now. So that sell-off could get worse. The market punished them bad. But I remember saying to clients back then that, the core business of Meta is still the advertising, and they're making an absolute fortune on it, and they still are. So anytime they say and they stop their spending, the share price is due to rally, in my opinion. So if you think, buying the stock here is not a bad idea in my view, and you could always average in if it does fall further. Another way to go is look at the call options on Meta. So let's have a quick look at the Meta calls. And remember kind of our rules at home on buying call options. If you're going to buy a call option, you need to go out at least 90 days, in our opinion, 60 to 90 days. And the reason for that is you're trying to avoid the theta decay. So let's look at January, which is a 70-day expiry. And we want to look at deltas that have about a 0.7. Now, they're going to be more expensive. It's going to cost you more to buy this call option. But the plus side is you're more likely to finish in the money on your call, which means that there's going to be some type of value in there. So that would be like this 585 strike. And it will cost you $6,000 a contract. Now, one contract, for those who don't understand options, it's 100 shares you're getting control of. So if you were to actually buy Meta outright, it would cost you about 100 shares of Meta outright. It would cost you about $60,000. We're getting control out of this for $6,000 for similar upside potential. So that's a trade that you could look at if you were considering, because Meta doesn't pay a great dividend, you could look at the call option route. The downside of buying calls, I just want to reiterate this, and it's low probability of profit. So just be aware of that. So if we look at that trade over here, you can see the probability of profit is 41%. If you bought the stock, your probability of profit will be 50%. And the reason the probability is lower is that your break-even price is higher. So in order for us to break even at expiry, Meta would need to trade above 646. It's currently at 621. So that's the reason why our probability profit is lower. The plus side of using the call option is, well, all you can lose is 6,000, where theoretically, if you bought 100 shares of Meta, you could lose 60,000. So that's one reason. And the other reason is you're putting down like a deposit here to get massive leverage on the upside. So if Meta did go to 700, for example, you would make a much higher return on investment for your call option than you would if you put your capital away in your stock. And then the third reason is that capital that you don't use buying up the stock